journey and your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some key died.
One of the most important concepts in capital cost allowance is understanding when a corporation is actually allowed to begin claiming the deduction. Many beginners assume that as soon as a business purchases a capital asset, capital cost allowance can immediately be claimed. However, that's not always the case. In many situations, purchasing the asset and being able to claim capital cost allowance are two different events. To understand this, let's look at the typical journey of a capital asset. The process often begins when the corporation decides to purchase a new asset and places an order with the supplier. Once the purchase is completed, the corporation receives the purchase invoice, confirming that ownership has been established. The next step is delivery. The asset arrives at the corporation's location. But simply being delivered does not necessarily mean it is ready to be used in the business. For many assets, additional work is still required. A manufacturing machine may need to be installed. A computer network may need to be configured. Specialized equipment may require testing or calibration before it can perform its intended function. Only after the asset has been installed, prepared, and is ready for its intended business use does it generally become available for use. This is the key point. The available for use rules focus on when the asset is actually ready to be used in the business, not simply when it was purchased. Once the asset becomes available for use, the corporation can generally begin calculating capital cost allowance, subject to the applicable tax rules. Now compare two different situations. In the first example, the corporation purchases a manufacturing machine, but it remains in storage waiting to be installed. Although the corporation owns the machine, it is not yet available for use. At this stage, capital cost allowance generally cannot begin. In the second example, the same machine has been installed, tested, and is ready for production. The asset is now available for use, meaning it may now qualify for capital cost allowance under the applicable rules. This timing distinction is extremely important because claiming capital cost allowance too early can result in errors on Schedule A. Professional tax preparers always verify that the asset has become available for use before calculating any deduction. The key lesson from this slide is simple. Buying a capital asset does not automatically mean capital cost allowance can be claimed. The asset generally needs to become available for use before CCA begins. Professional tax preparers always verify the timing, confirm that the asset is ready for its intended business use, and only then calculate capital cost allowance and complete Schedule A. The available for use rules are all about timing. Professional tax preparers know that purchasing a capital asset is only the beginning of the process. Before capital cost allowance can be claimed, they must confirm that the asset is actually ready to be used in the business. Let's look at the review process step by step. The first step is the purchase of the capital asset. Once the corporation acquires the asset, the tax preparer gathers the supporting documents, including the purchase invoice and any records that describe the transaction. Next comes delivery. The asset must first arrive at the business location. However, simply receiving the asset does not necessarily mean that capital cost allowance can be claimed. Many assets require additional work before they are ready to perform their intended function. For example, manufacturing equipment may need to be assembled and installed. Computer systems may need to be configured. Specialized machinery may require testing and calibration before it can be placed into service. After installation is complete, the tax preparer confirms that the asset is ready for business use. This is the key step in the review process. When the asset is fully installed, operational, and ready to perform the function for which it was purchased. It generally becomes available for use, subject to the applicable tax rules. Once the available for use requirement has been satisfied, the corporation can generally begin claiming capital cost allowance. The calculation is then completed and recorded on Schedule A. Before making that claim, experienced tax preparers perform one final timing review. They ask several important questions. Has the asset been delivered? Has it been installed? Is it ready to perform its intended business function? Are all supporting documents available? And has the available for use date been confirmed? Only after answering these questions do they proceed with the capital cost allowance calculation. To support this review, tax preparers typically rely on several important documents. These include the purchase invoice, delivery receipt, installation report, fixed asset register, Schedule A, and supporting working papers. Together, these records help establish when the asset became available for use and support the corporation's capital cost allowance claim. One of the most common beginner mistakes is claiming capital cost allowance immediately after purchasing an asset without confirming that it is actually available for use. Doing so may result in claiming the deduction too early, leading to incorrect Schedule 8 calculations, future undepreciated capital cost errors, tax return adjustments, or reassessments. The key lesson from this slide is simple. Professional tax preparers never rely on the purchase date alone. They confirm that the asset has been delivered, installed, and is ready for its intended business use before determining that it is available for use. Only then do they calculate capital cost allowance and complete Schedule A. Following this structured timing review helps ensure that capital cost allowance is claimed in the correct taxation year, and that Schedule 8 is prepared accurately and supported by complete documentation. Before claiming capital cost allowance, experienced tax preparers perform one final timing review. This review helps ensure that the deduction is claimed in the correct taxation year, and that every requirement has been satisfied before completing Schedule 8. The review begins with the capital asset itself. The first question is simple. Has the asset actually been delivered? If the asset has not yet arrived at the business, it generally cannot be considered available for use. After delivery has been confirmed, the next question is whether the asset has been installed or set up. Many types of capital assets require installation before they can perform their intended function. For example, manufacturing equipment may need to be assembled, computer systems may require configuration, and specialized machinery may need testing before it can be placed into service. Once installation is complete, the tax preparer confirms that the asset is ready for business use. This is one of the most important steps in the entire review process. The asset should be capable of performing the purpose for which it was acquired. Only after confirming that the asset is ready for use does the tax preparer determine the available for use date. That date is important because it helps establish when the corporation may begin claiming capital cost allowance, subject to the applicable tax rules. Once the timing has been confirmed, the tax preparer determines the correct capital cost allowance, or CCA, class, calculates the allowable capital cost allowance, completes Schedule 8, and updates the corporation's asset records. Throughout this review, experienced tax preparers ask themselves several important questions. Has the asset been delivered? Has it been installed? Is it ready for business use? Has the available for use date been confirmed? Is the correct CCA class being used? Has Schedule 8 been completed accurately? And are all supporting documents available? These questions help ensure that the deduction is claimed at the appropriate time. To support this review, tax preparers typically examine the purchase invoice, delivery receipt, installation report, fixed asset register, Schedule 8, financial statements, working papers, and any additional documentation related to the asset. One of the most common beginner mistakes is claiming capital cost allowance before the asset is actually available for use. Claiming the deduction too early can result in an incorrect capital cost allowance claim. Reporting it in the wrong taxation year. Incorrect undepreciated capital cost balances. Tax return adjustments. Or even reassessments. Fortunately, these problems are usually easy to avoid by following a consistent review process. The key rule to remember is simple. Before claiming capital cost allowance, confirm that the asset has become available for use. Verify the supporting documentation. Determine the correct CC class. Calculate the allowable deduction accurately. And record everything correctly on Schedule A. By following this professional timing review every time, you'll prepare more accurate corporate tax returns, claim capital cost allowance in the correct taxation year, maintain reliable asset records, and avoid many of the most common Schedule 8 errors.